Today on Keynote.
Whatever combination of AI, machine learning, whatever you need to do it efficiently, it doesn't matter. It doesn't like whatever works. I don't care if there's large language models in it or not. What matters is if you're delivering measurable value that customers are willing to pay for.
My name is Bill Russell. I'm a former CIO for a 16-hospital system and creator of This Week Health, where we are dedicated to transforming healthcare one connection at a time. Our Keynote show is designed to share conference-level value with you every week. Now, let's jump right into the episode. All right, it is Keynote. Today, we're joined by Branden Fini, partner with Allumia Ventures. Branden, welcome to the show.
Thank you. Thanks for having me, Bill.
We're going to talk investing. We're going to talk healthcare IT investing. Before we get there, though, I want to establish your bona fides. You've been doing this for a while. You were with Branden Ventures, and so you're not new to the game. Give us a little bit of that background and that story.
Let's see. Most of my career, like 95% plus, has been spent not having a real job, which means being an investor, moving money around, so to speak. The pessimistic view is, yes, moving money around and hoping things work out. But on the more optimistic side of things, and how I'd like to think of it, is really there are several inputs and stakeholders that are required to make change happen and innovation happen in any industry, and healthcare is no exception. And being an earlier stage and growth stage investor is one of those inputs to providing capital and other non-financial things to companies trying to make a real difference. And so I've had various investor roles for it's been almost 15 years now. I came from a STEM background. So in college, I studied math and chemistry, and that's how I spent vast majority of my time, with an eye towards going to med school. And then as I started getting more and more involved in purely medical things like shadowing physicians and leaving the classroom and leaving the research lab, I got pretty disillusioned with where healthcare as an industry was heading outside of the purely scientific endeavors of healthcare, because healthcare is so much more than that, for better or for worse. So I shifted my eye towards wanting to do something that I believe would make a different kind of impact than being a sole practitioner in this very convoluted but critical industry. And so I made this decision to go into to venture capital, not from the financial perspective, but from the let's change healthcare perspective. So really healthcare first, finance second mentality. I wasn't like this investment banker guy.
Although you're really both. You're the numbers guy and you're the healthcare guy.
I try to be. Coming from when you look at my formal background of how I was trained and what I studied and the environments I was in, like it was purely scientific and mathematical. And so shifting my mind towards something that's very fuzzy and uncomfortable, which is like making predictions and putting your money where your mouth is, which is what investing is. It can be very uncomfortable. It was quite the transition for me, given like my very framework-based way of thinking. But anyway, so I made that leap into venture capital. I started out at Sandbox Industries. Sandbox is on the other side of where I was with Branden Ventures, where they were strategic, but on the payer side of things. So Sandbox Industries, they started over 20 years ago now, but they're one of the exclusive strategic fund manager for dozens of Blues plans around the country. And they too focus on healthcare IT. So that was my entry point into the world of healthcare investing. And then I ended up going to a life sciences focused firm, so more like pharma and med tech out of Southern California. I spent several years there. And coincidentally, most of our investors whose capital we managed, they were actually high net worth physicians, specialists mostly, as opposed to primary care. So these were like ophthalmologists, a lot of plastic surgeons and dermatologists, very private practice heavy type specialties that deal with a lot of cash pay stuff. So I was there for 4 or so years, and man, that just validated my thesis on healthcare, especially for physicians and providers, really needs to be fixed. I left there. I went to business school because I had no business training at all formally outside of the job, and learned what business even means for the first time. I was at Wharton for 2 years. And that's when I kind of, with that experience combined with my several years at that point of healthcare investing, broadly speaking, I had enough information to choose what sector within healthcare do I want to focus on and what stage. At that point, that's when I really chose I want to be in healthcare IT digital health. There's a lot of names for it. Working with healthcare companies that are using some flavor of information technology to advance healthcare, whether it's for patients directly, for providers, for payers, name your healthcare stakeholder, and specifically companies that are earlier stage that are on the edge of doing something new versus those that are 100 million plus in revenue, ready to go public, that sort of thing. So that's what I chose to eventually do with my life.
Here's what's interesting to me about this. I was in a room with you and some other healthcare leaders, and we were talking about investing and whatnot. After you got done talking, I realized when I was at St. Joe's, we got some money, and me and three other people, the CFO and some other people, we were hobby investors. And I use those words because I'm not offending anyone because St. Joe's doesn't exist anymore. But man, we had no idea what we were doing. After the conversation with you, I was like, man, we had no idea what we were doing. And I told you, I'm like, hey, at least one of our companies did really well. And out of how many? I said, out of four, you're like, hey, good hit rate. And I'm like, really? That's a good hit rate? You're like, yeah, that's a pretty good hit rate. I mean,
Yeah.
I was in that room with you and I was listening to people talk about their investments, and we talk with great pride about our investments. And really, you don't know how good your investment is today. You were giving, I remember you threw out some stat in terms of the number of early stage investments that actually become, I think we were talking about unicorns at that point, number that actually become unicorns. It was really low.
I'll give you two stats that I like have on my mind, these two stats almost every day. It'll give you a glimpse into my investment philosophy, which then determine the decisions I make and how I view companies. But stat number one is of all the companies in our space in healthcare, even the life sciences companies like pharma and biotech, and you look at all the companies that have exited and actually had a realization event, whether it was good or not, of all the companies that have exited, the median exit value for these companies over the past 20 years, it's 200 million. It's 200 million is the median exit value. And two-thirds of these companies are exiting below the 300 to $350 million mark. And so the fact that this pool of data, and these are thousands of companies, this pool of data already represents outliers. They succeed in actually returning proceeds to their investors. So when we invest in a company, we have that in mind. We're like, this company, on average, if we exit it, we're targeting a $200 million exit value, and there's certain characteristics of the specific company that might make us confident that they could go above that, sometimes even well above that. But on average, or I should say on median, that's the true north. And with that in mind, you have to then do two things as an investor when you think about doing a deal, other than looking at the company as a product and service and management team. You have to look at how you value it going in and then how much capital the company raises, because both of those two variables, the valuation and how much money the company raises, those will affect the ultimate return, because you have this kind of target median return of 200 million. And if you're targeting, depending on the stage you're investing in, let's say you're targeting a 3x return, which is like a gold standard growth equity return. And that's a number that we hear thrown around by a lot of different stakeholders in our community. And that's something that we hold ourselves accountable to. If you want to make a 3x return on an investment, if you value the company too highly, or other investors do, and you join in and put money in, then that'll depress your returns, even if the company does really well, because they're going to exit for whatever they're going to exit for. And that will ultimately determine your MOIC, your multiple on invested capital. So that's one big statistic, and I talked more than I should have, but that's one big thing we look at, is just the distribution curve, the exit value distribution curve. The other one is there is next to no correlation. If you look at the data and do a correlation analysis, there's next to zero correlation between a company's exit value and how much capital has been put in the company over its lifetime. So you see these companies coming out of certain really hot sectors or geographies, and they raise a $50 million seed round, for example, and they end up raising hundreds of millions thereafter. Sometimes it works out, but on average, there's no correlation to how much money they raise and their ultimate exit value. And so those two big kind of statistical threads determine this philosophy we have, which is you have to be very disciplined in how you value companies and what you price them at when you enter as an investor. And then companies should not be raising more capital than they need. They can't be overcapitalized because it depresses returns. Not to mention management ends up spending it all and you could put yourself in a precarious position. But
So my investment thesis in the market has always been I invest in people, not in companies. And so I look at leaders of companies. I remember back in the day, I made a bunch of money investing in Disney. And this back when I was
oh,
just coming out of college, and Michael Eisner was there. And everything I read about Michael Eisner, I'm sitting there, I'm reading it going, yeah, that's right. That's right. He was making good decision after good decision. And I invested in him. I made a bunch of money on Sprint because I invested at a time
mm.
when I believed in the leader. How important is the leader or leadership team? I read articles on investing and they seem to weight that very heavily.
So the short answer is, yeah, that's like among the most important things. And we weigh that heavily. And we weigh a CEO's ability to do a lot of things, not just make good decisions and lead, but also surround him or herself with the right team and having certain characteristics like being coachable, having clear communication ability with the board because we're always on the board and it could make or break a company when the board is dysfunctional and the CEO can't like clearly articulate critical information to the board, and that does happen. So we do all that, but I'll tell you more specifically, just coming from personal experience, if I were to add a little more detail on why the intuition actually proves to be correct in this case, it's because as an investor we have a standardized general framework of how we evaluate investments. We look at the company's performance, line of sight to future growth, the profitability profile, how differentiated their product or offering is, the market size and competitive dynamics, et cetera. Like we do this full months long diligence process that kind of covers all of these dimensions. But what you realize as you like lock arms with companies after you invest in them and sit on the board which is things I've had the privilege of doing. You realize that you could collect all the information that you're given time to collect, but at the end of the day, by the time you make the investment decision and actually wire the money to the company, you still only have some low percentage, well below 50% of all information that will fully inform the outcome of the investment, of course. And so, how do you get comfortable with the balance of information you need to really feel confident in the investment? That's where the people come in. They're the ones that are actually navigating the business through a dynamic environment. They're the ones making day to day operating decisions. They're the ones actually talking to customers and doing the day to day activities that investors sometimes take for granted. And I'll give you one big example. Investors will oftentimes take for granted how important it is for you to really nurture existing customer relationships, especially with early stage companies. So many investors focus on growth. Let's acquire as many customers as we can and get the contract sizes as big as we can. But then what happens a year later, 2 years later, when you don't deliver on the implementation or you're not delivering on the product on the roadmap that you're promising the customer, you're going to lose that customer. And then you'll have to pay the piper 2 years later or whatever the timeline is. And seemingly mundane things like that, a lot of investors don't think about. Again, that goes back to that's the management team and their ability to do a variety of things that you need to depend on because you're not the one in the room. It's the management team and then others.
Every now and then I coach startups and I don't specifically coach them on going and asking for money or looking for money. It's really interesting to me. That's a whole consulting gig in and of itself. But when they ask me, one of the things I will say to them is, do you need the money? Like I start with that. Is, do you need the money? Because if you don't need the money, I'm not sure you need the headache
It's a headache.
of doing all this stuff. It's interesting because people start a company now with the whole idea of how much money they can raise. Almost seems to be the starting point. I would think if I were starting a company in health IT, the first thing I would find is an enabling client. I'd find a sandbox. I'd find somebody that's willing to work with me on
Mhm.
development of that product and moving it along, potentially giving me my first contract. Because knowing what I know about sales within healthcare, a lot of it is referral based. You
Yeah.
get that first client, you go to the second, go to the third. I would spend a majority of my time there versus, man, how are we going to position this to raise money and all that other stuff? Or am I not thinking about this correctly?
No, I completely agree. I would go even farther and say, even when you're working with your initial customer, call them like an anchor customer or innovation partner, whatever you want to call them. I agree with that strategy. But even within that customer, There's this kind of a catch-22 dynamic that entrepreneurs deal with when they're first starting out, or maybe when they are even going to a new market and they're expanding the company, is technology splash solution versus need and pain point. Are you building a technology looking for a problem? Or is it the other way around where you've identified the problem and the pain point and you are now building the solution that will optimally address that problem? And I would hope entrepreneurs choose the latter, which is you don't want to over engineer and over invest on this fancy, cool, slick tech product and hoping you'll come across some use case that you can attack and customers will pay for it. It should be the other way around. Like you got to be very clear in what pain points you're solving. Make sure that the pain points are clear. They're a top priority for whatever customer market you are addressing. And then you build something that's unique and that delivers tangible business value that's measurable. And whatever combination of AI, machine learning, whatever you need to do it efficiently, it doesn't matter. It doesn't like whatever works. I don't care if there's large language models in it or not. What matters is if you're delivering measurable value that customers are willing to pay for.
It's interesting. I think a year ago, somebody said, yeah, hey, we need 18-month ROI, or as a health system buyer or leader, we need 18-month ROI, or we can't even consider it. And I've only heard that number go down. And I'm now hearing things like, hey, if we can't get ROI on the big project within a year, we need to do a smaller project, get the ROI, and that will fund the project after that. I'm hearing just getting to that point of solve a very distinct problem for me as a health system leader and be able to validate that ROI. A lot of times that measuring that ROI is a very difficult thing for organizations to do. They'll say things like, we're solving the burnout problem. It's, oh, okay. Does that mean they're not having to hire more nurses and clinicians? Does that mean they're not losing them? Because one of those is easier to put a number on than the other, because the others is not as hard to quantify. And we get into those projects all the time in healthcare where the CFO just looks at us and says, hard ROI only. Don't give me any of this soft ROI. I mean, it's very real ROI, but if you can't prove it, it's soft.
Yeah, oh my gosh, there's so many dimensions to characterize what ROI means. So you mentioned a couple. One is like the payback period of ROI. Number two is like attribution, like to what extent is this ROI like measurable and coming from you, the vendor? And then there are a couple other dimensions where it's like, is this ROI coming from cost savings, or is it ROI coming from like you are actually capturing revenue for us and margin, revenue with margin? Or is it like defensive ROI, where you are helping us, to your point about burnout, you're helping us actually prevent bad things from happening, like preventing churn. Or in cybersecurity, that's a common one where you're preventing attacks from happening. How do you measure ROI on things that end up never happening? Measuring ROI is an art and a science, and it can be very tricky, which is why, like, this gets back to the stage of investments that we choose to focus on. You mentioned like what metrics we look at. We certainly look at metrics, but metrics are manifestations of what we really care about fundamentally, which is companies that have like clear signs of product market fit and they've demonstrated ROI to their customers. Even if it's a few customers, even if they're early, there has to be some value prop, which ROI is a part of that. Some value prop story that's clear, that's compelling, and demonstrated. And then what we need to do as investors is determine whether that value prop is actually compelling and real and being received by the market, and understanding if it's scalable to a broader swath of the market and how that translates into the adoption rate and ultimately the growth of the business long term.
And I'm trying to figure out these different rounds. So I've seen rounds where people will take that money and they will double down on the product, maybe enhance the product, maybe come up with a new application for the product and that kind of stuff. And they will hire some key people. I see other rounds where all of a sudden they're out hiring 20 salespeople and 5 marketing people. I see some investments where they come out of it and all of a sudden there's marketing dollars going all over the place. There's sales dollars going all over the place. And I'm like, okay, when they went in to the meeting with you, they essentially said, we've got market fit, we've got subtraction, we've got this. We now need to capture this market. And there's a focus and a thesis on we have it. We just now need to get this in as many health systems as possible, as quickly as
Yeah.
possible.
Yeah.
Is that how it goes? You have different kinds of conversations depending on where they're at?
Yes. Yeah. I was writing down a list over here of the different inflection points, I guess you can call it, of a business where, like, once they reach that inflection point, that's when they should, on average, raise money because that's when they've demonstrated a certain stage of maturity. So, like, the first one would be coming up with the actual idea. That's very early. And that's like a founder and one or two founders. And then it's building the actual working product, the MVP product that helps that idea become actualized. And then once that product,
And that's, we're still not at an early stage. You're still not investing in that company.
I'm still, yeah, we're still not investing at this point. This is still like pre-seed investing, is when you have a small founding team, like 2 to 3 people. Maybe they're outsourcing some engineering work to actually build the product, but you still have a very technically oriented founding team that's like the CEO slash CTO slash chief sales officer. They're just doing everything because they're the visionaries and they're the ones that founded the company and they're the ones overseeing the product. So then you have the product that's built, but you still only have like less than 5 people doing it. And maybe they end up realizing, okay, hey, the product is built, it's working. We're working as a small founding team. This is great. Let's go back beyond angel investors and our own money, and let's raise maybe from a seed stage VC, an institutional investor that will give us 2 to 4 or 5 million dollars to take the product we've built that works, that we believe will be validated in the market, and let's grab a few customers and actually sell this thing into customers, including that anchor customer you talked about. And then they go try and do that. And that may or may not be successful, but let's say it's successful. Then they realize, oh man, there might be product market fit here. We need to raise more money to really validate if there's true product market fit here, because we only have 3 customers, and we need to actually hire more people. We need to hire a small engineering team. We need to build out some just company infrastructure, like accounting, someone who heads up finance, still keep the team small, less than 15 people, but like something's real here. And after they're able to do some of that's when we would come in. So we would come in when they have a few customers that are not pilot customers that are showing really strong signs of, hey, these customers are happy. There's clearly a value prop they're delivering. They've been working with these customers for more than a brief period of time to show how they actually work with customers. There's some expansion in 1 or 2 of the customers, and everything's going pretty well. And we've spoken with a bunch of prospective customers, and they're saying the same thing. So these are actually, maybe there's a broader market opportunity here, but they still don't have, at that point, they still don't have a full-time sales team. The founder CEO is still doing most of the sales work. There's not this huge pipeline of prospects because they don't have the resources to build that pipeline. And so, like, with our capital, they would hire a handful of full-time salespeople. They would institutionalize the company a little bit more, and they would go grab additional customers and expand the product, enrich its feature set. Maybe there would be some pivots along the way of what the ideal client profile might be. And then we would go all the way up to a company that's already done all that and has at the beginnings of a sales team, and they just want to expand. They just want to, it's purely execution, and they want to just continue growing like they have been. And upside opportunity is like expanding into a new product category or a new market. And that's upside opportunity.
So talk to me about validation. There's obviously market traction, there's commercial traction of the product, and people are validating it by writing checks and expanding orders. In some of these things, there's also clinical validation. I went back and forth with somebody on LinkedIn, and they were saying those computer vision AI models don't have the peer-reviewed articles to blah, blah, blah. Now, I'm sitting there, I'm reading this thing going, yeah, and everybody's buying it. So everybody's buying it. Do they really need the clinical How important is clinical validation versus commercial traction? Is it just one of those feel kind of things?
It's a sliding scale, it's a spectrum. So on one extreme end of the spectrum, if it's an interventional clinical technology like a medical device, like they have to get FDA approval. Clinical validation is everything, right?
Right.
Everything. All the way to something that's not even really dealing with clinical things, it's more administrative, but maybe clinicians are using it, but again, it's not a clinical solution. Then there's clinical validation is even a relevant question. So that's like the spectrum. So you have all these things in the middle where clinical validation, it just depends. It depends on how standalone it is. That's one dimension. Is if this is being used in conjunction with clinicians and clinician oversight, then this technology's ability to do clinical things on its own is less important because it's not used alone. Whereas in other categories, clinical validation is actually a part of the value prop. Like to give you a tangible example, a care navigation tool that helps identify patients that need referral loops closed or they need to see a specialist because something was identified in the clinical documentation and they want to close those care gaps, that sort of thing. Clinical validation will be important if part of the value of that type of technology is to actually identify patients that could have incidental findings and potentially have nefarious findings that could lead to
Oh yeah.
mortality, like some cancer thing. Like that would be part. If having a clinical value prop is like a key buying decision criteria, then clinical validation is very important versus another care navigation solution that does a similar thing, but it's purely sold as, hey, we're trying to close referral loops to capture patients to grab revenue for you guys. Like the clinical validation is less important. What's more important is making sure it works and that you're not hounding patients and you're just compliant.
I have a million questions. Let's do quick answers on this. Does it matter if they only have two clients? Does it matter who those clients are?
Definitely. Yeah. It matters whether they're market representatives or not, whether they're early adopters of solutions or not. If you're selling to an academic medical center that's known to have a really big budget for new shiny stuff, that's different than being able to sell into Providence.
Right.
Really hard to sell into.
Areas in health IT investing that are oversaturated right now? Are there any spaces? Telehealth was there for a while. I don't know. Is AI getting, are there other spaces?
Yeah. I'd say anything using generative AI is going to be oversaturated, especially things that are administrative in nature. There's like administrative versus clinical. Those are the two big segments. AI's low hanging fruit is in administrative stuff like revenue cycle related activities, anything related to patients' communication and engagement, like replacing a call center or whatever it is. Yeah, there's a lot of stuff out in both of those, like patient communication and relationship and revenue cycle.
Any areas underfunded?
That's part of being an investor is you can't just identify good opportunities. You have to identify good opportunities that are also in categories that are underlooked. Because if they're underlooked, then there's going to be less investor competition and you're going to have more levers as an investor in getting and actually pricing that asset appropriately because of supply and demand dynamics.
I've dealt with a bunch of, again, startups and some founders who will complain about health systems. It always just makes me giggle a little bit. It's first of all, this is the space you've chosen to be in for starters. It is what it is. And then they'll bemoan the fact that it's like their teams move too slow. They can't get this implemented, whatever. How much I always put it back on them. I'm like, look, if my business required health system to implement this correctly and quickly, then I would spend just as much time on that aspect of my business, the implementation quickly and
I
effectively, as I do
totally agree.
on the product. All right.
Totally agree. Yeah, of course. I hear it all the time, and we've dealt with it ourselves. Even though we're not entrepreneurs selling a product, like we are investors dealing with managing health systems capital. So we too are selling to them. So we know how slow health systems can move. And I think we have a better appreciation of why that's the case. And it's still incredibly frustrating sometimes. Boy, it
The
is.
the current environment in DC, does that change the equation? We have potentially changing reimbursement models. We have DOGE, which people are concerned about. We have potentially taxing the endowments. We have NIH funding. We have a bunch of things going on that creates uncertainty. I assume uncertainty is just bad for investing in general.
It could be good or bad. It can be bad on one hand because, yeah, you don't have all the information that can make you squeamish, or it could be good because it might filter out a lot of these, you said hobby investors, the tourist investors that don't know as much about that certain category of regulation. And so it creates less crowds and filters investors out. And if you are able to access information that others can't as an investor, these are private markets. There are huge information asymmetries, then that could open up investment opportunities. So it just depends on exactly what you're talking about. When it comes to the new administration, like, I don't think they're going to repeal the ACA. Trump tried that last time. I don't think that's going to happen. And I think the things they've been discussing are going to be targeted on cutting Medicaid funding, scrutinizing Medicare Advantage plans more. Those are the two big things that keep coming up. That Dr. Oz, who's going to head Medicare, his last Senate hearing just last week, he talked a lot about Medicare Advantage billing practices around upcoding and all that. And so we expect scrutiny in those categories, but that'll just really inform how we look at companies versus making us less optimistic about the investment universe.
This will be the biggest softball question in history. Having been in a health system and part of a team that was investing in things, would you recommend for health systems that they just partner up with investment firms who know how to evaluate this stuff? I think about the investments we were making. We had an advantage in that, first of all, we knew the problem set, we knew how we were using it, we knew what the returns actually were on the product. We had firsthand knowledge of the products that we invested in. We didn't invest in things we weren't using. And generally, we had a lot more feedback, I guess, just firsthand feedback on the product. On the flip side, there are so many aspects we did not understand. We did not have professional investment experience. We made mistakes. We did not ask for board seats. There's just a whole bunch of just run of the mill mistakes that we made. Do you find it to be more effective for health systems to go this route of trying to go ahead and start their own funds and invest, or do you find it to partner with firms that do that?
You already know what I'm going to say, but I'm going to preface it with saying this is no different than any other buy versus build decision of any company ever, which is when you build your own stuff, it's going to be when you're able to leverage your unique core competencies, and you tend to outsource things or partner with those who are much better at doing whatever goal you have, can do it better and do it more efficiently, like more capital efficiently. And when it comes to a health system, like their core competency is going to be caring for patients, employing and working with providers, managing hospitals and other healthcare facilities. And their unique assets are going to be that patient reach and patient relationship and brand recognition and access to providers. That's what health systems and hospitals uniquely have. When you, as a health system, want to do anything outside of that scope, that is when you should start considering outsourcing or partnering, because that's not your core competency. And when it comes to financial investment strategies and decision making, that could not be farther from delivering care to a patient. It is extremely out of scope for health systems, even though they know the product that you're investing in. That is one of countless dimensions that go into making an investment decision that could return capital at an attractive rate.
Yeah, but I've heard people say that hospitals are just banks that happen to have patients. They do have billion-dollar funds that they're investing, but that still doesn't give them the wherewithal to manage those funds effectively. And in a lot of cases, those billion-dollar funds are being managed by somebody else.
Yeah, that's the thing, is like when you think about these large health systems or insurance companies, it doesn't have to be a health system. They can have tons of cash. And so that's their asset, is they have the cash, but how to deploy that cash into an investment strategy outside of just actually running your operations. There are experts for that. And that's why investing in fund managers, why that whole universe even exists.
We'll close with this. As you're looking at Allumia, and how do you see the next year unfolding? Where do you see opportunities? Where do you feel like you will spend the most time over the next year?
That's a big question. Or at least I'll tell you what I hope will happen. What I hope will happen is when you think about some of the biggest problems in healthcare, at the top of that list is you talked about provider burnout. I'm going to make it a broader point around provider shortage. The caregiver shortage generally is big and it's getting worse. And so we want to spend time on really trying to find technology solutions that are actually going to alleviate that shortage and actually scale providers' ability to care for more patients better. So that's one big category. Another one is like when you think about the changes that the new administration is likely to make, you think about, like I said, Medicaid and more vulnerable populations. Vulnerable populations it's a big nut to crack on a variety of levels. Lack of funding, profitability when it comes to Medicaid solutions, and just they're a hard population to manage and they drive a lot of spend. And so that's another category that we're going to spend a lot of time on, is like alternative care delivery models or engagement models for that hard to reach and hard to manage population. A third one is going to be, I think, as providers continue to consolidate more, as health systems consolidate, and payers, United leading the way, becoming providers more and more, looking for investment opportunities that I think capitalize on those two trends. Because I think since COVID, with payers becoming providers more, new market entrants coming in providing care like Amazon with its acquisition of One Medical, and then health systems financial models like the fee for service financial model being compromised. Those three mega trends have all been, I think, intensified since COVID. So looking at things that could help advance that even more.
I want to thank you for your time and thank you for the education of Bill Russell. I appreciate you participating in that process.
Sure. Of course, of course. And thanks for giving me the time.
Thanks for listening to this week's keynote. If you found value, share it with a peer. It's a great chance to discuss and in some cases start a mentoring relationship. One way you can support the show is to subscribe and leave us a rating. Love it if you could do that. Thanks for listening. That's all for now.